In this episode, we are going to discuss the sources of income. So at first, we're going to talk a lot about fruit and trees and how that all relates to the assignment of income, as well as how personal services, property, interest, dividends are treated and how they are included in income, as well as how community property laws in certain community property states affect how income is treated on a tax return. So let's get started. So to begin, we need to start with one of the most quintessential tax cases that there is, Lucas v. Earl, and the fruit of the tree analogy that came from this particular case. So in Lucas v. Earl, Mr. Earl had an agreement with his wife that she was to receive 1/2 of his income. Now, this was an attempt by Mr. Earl and his wife to establish community property rules among themselves. And that's because in community property, what occurs is that both parties in a marriage are treated as receiving 1/2 of the income of the other spouse. And during this time in the 30s, there was no such thing as married filing jointly or married filing separately, etc. These two parties were filing on their own tax return. And so to receive better tax rates, each party, Mr. Earl and Mrs. Earl, would receive 1/2 of Mr. Earl's salary. Well, the Supreme Court came down and they came up with this idea of the fruit of the tree analogy, or what's also known as the assignment of income doctrine. And what it says is that fruit must be attributed to the tree from which it came, or in other words, the income must be attributed to the person who earned it, or in this case, Mr. Earl. So an assignment of income does not shift the tax liability. Tax must be paid by him who earns it. So for example, services performed by an employee for the employer's customers are performed by the employer. Also, amounts earned by a child are included in the child's gross income even if payment is received by the parents. Now, how does this apply to property? Well, the fruit of the tree doctrine is then changed to say that the tree is the property and the fruit is the income. The owner of the tree has control over the fruit and therefore pays tax on the fruit the property produces. So for example, Mr. Galt in Galt v. Commissioner owned a fairground in Illinois, and he gave each of his 3 sons 1/5 of the rental proceeds for 21 years from the fairgrounds. So when he was audited for one tax year, Mr. Galt was found by the tax court and the Supreme Court to have failed to include 3/5 of the rental proceeds in his income. However, had Mr. Galt given 1/5 of the property to his children, the children would have been taxed on the proceeds. And why is this? It's because instead of giving the property to his kids, he just gave the proceeds from the property to his kids. And the fruit of the tree doctrine here states that the property is the tree, and whoever owns the tree is therefore taxed on the fruit or the income of that tree. Therefore, Mr. Galt had to go back and amend his tax returns to include that 3/5 of the rental proceeds into his income. Now, what about interest? Well, first we have to talk about interest. Interest accrues daily unless there is a sale. Then the interest is accrued at the sale. Now, when it comes to a gift of property, the donor, the person giving the gift, must recognize his or her share of the accrued income or interest at the time it would have been recognized had the donor continued to own the property. Now, if somebody sells such property, the transferor, the seller, must recognize the accrued income at the time of the sale. This results because the accrued interest will be included in the sales proceeds. So let's go over an example. Emmett, a cash basis taxpayer, gave his son Mike corporate bonds with a face amount of $15,000 and a 5% stated annual interest rate. The gift was made May 31st, 2017, and the interest was paid on the last day of each quarter. So, how much interest must Emmett recognize? Well, first, let's take the basis in the corporate bond of $15,000. We then multiply that by the interest rate of 5%. Now, we must only include the amount of interest that he would receive during the time that he owned it. And so we look at how many months out of the year he owned the bonds, and that would be 5 months, since it's May, 5 months out of 12. But then interest is paid by the quarter. So then we have to look at what month out of the quarter he then sold the corporate bond. And so if we take January, February, March, the first quarter, second quarter, April, May, June, he owned the corporate bond for April and May. So 2 out of the 3 months of the quarter must be included in Emmett's interest. And therefore, the total amount of interest he must recognize on his tax return is $208.33 of interest. Okay, let's go to another example. Kim purchased a corporate bond at its face amount of $10,000 on January 1st, 2017. The bond pays 5% interest on each December 31st. On April 30th, 2017, Kim sold the bond for $11,000. So how much interest and capital gains must Kim recognize? So let's start with the interest. Technical difficulties? All right, so to calculate the interest, we first take her basis or how much she paid for the corporate bond of $10,000, and we multiply that by the stated interest rate of 5%. Then, since the interest is paid at the end of each year, we're going to divide how much interest she incurs by how many months she owned it out of the year. And so she owned it until April 30th, or the 4th month out of 12. And so her interest that she has to include in her tax return is $167 worth of interest. Now let's go to the capital gains. To calculate the capital gain, we must first take what she received from the sale. So she sold it for $11,000. We have to reduce the amount of the sale by her interest of $167. So sale proceeds and interest. Because she's already being taxed on the interest, and the interest was a part of the corporate bond, we now reduce that and we are given an amount of $10,833. Now we have to remove her basis in the bond of $10,000, and that gives us a total gain on sale of $833. All right, so that's everything we want to know about interest. Let's move on to dividends. All right, so with dividends, you receive an investment payment for owning stock and contributing to the capital of a corporation. Now, the declaration of when a dividend is going to be paid is at the discretion of the corporation's board of directors. And the dividend is not like interest, it doesn't accrue daily. It just is at the whim. They can choose how much, they can choose when it will be given out to their shareholders. The dividend is taxed to the shareholder on record date. So what this means is that even if the dividend is gifted to family on or after the declaration date, the fruit of the tree doctrine would state that the fruit of the tree has ripened, and therefore the dividend should be included in the original owner's tax return. Now, you need to compare this with the Fifth Circuit, which states that if a dividend is gifted to a qualified charity, it is treated as if it's sold. And you need to compare that the dividend is not included in income if it is sold on or after the declaration date, only if it is gifted on or after the declaration date. All right, let's now move on to income received by an agent. Now, an agent is somebody who works for you or in your name. So an employee is an agent of a corporation if they are performing services for that corporation. So income received by an agent is taxed to the principal. A cash basis principal must recognize the income at the time it is received by the agent. So let's go through an example of this to illustrate. Jared, a cash basis taxpayer, delivered cattle to the auction barn in late December. Jared being the principal. The auctioneer, acting as the rancher's agent, sold the cattle and collected the proceeds in December. The auctioneer did not pay Jared until January. So when must Jared include the sales proceeds in his gross income? Jared must include the sales proceeds in his gross income for the year the auctioneer received the funds. So if Jared had delivered the cattle to the auction barn in late December 2016, and the auctioneer sold the cattle in December 2016 and paid Jared in 2017, then Jared would be treated as having gross income in 2016 when the auctioneer received the funds. Let's go to partnerships, S-corporations, trusts, and estates. These are pass-through entities, and what that means is that income from one of these entities is not taxed at that entity. The income and the deductions and all the items associated with that entity are passed through to the owners of the partnership, S-corporation, trust, or estate. So an information return is filed to provide data necessary for determining the character and amount of the distributive shares of pass-through income and deductions of each owner. Each owner then reports his or her own distributive share of income and deductions for the entity's tax year ending in or within the owner's tax year on their 1040. The owner is taxed on income regardless of whether or not the owner received any cash, as illustrated in this next example. Aaron owns 1/2 of the interest in the capital and profits of E&J Company, a calendar year-end partnership. For tax year 2017, the partnership earned revenue of $200,000 and had operating expenses of $50,000. During the year, Erin withdrew from her capital account $2,500 per month for a total of $30,000 for 2017. So how much profit must Erin report? So to determine this, we have to take into consideration how much Erin owns of the company. So 1/2. So we do know that of all the income and expenses and such, she only gets 1/2 that she has to report on her tax return. Now the company made $200,000, but the company gets to deduct the operating expenses of $50,000. Therefore, of the $150,000 of income, she only has to include $75,000 on her tax return. Now, she only received $30,000 of cash, but we don't care for pass-through entities. What we care is what type of income and deductions, partnership items incurred during 2017, and that would be the $75,000. For more information on the taxation of income and distributions, I provide you with this kind of summary of income and distributions are treated for partnerships, S corporations, or estates or trusts. Okay, lastly, let's look at income in community property states. It's a little bit different. And so, first off, community property rules only apply to the following states: Louisiana, Texas, Arizona, etc. Now, Texas, Louisiana, Wisconsin, and Idaho make income from separate property community property. Now, each spouse is taxed on 1/2 of the community income, which includes salaries, wages, and income from a professional partnership. The owner spouse is taxed on income from his separate property including property acquired before marriage, received as a gift, or received by inheritance following marriage. These separate property can become community property if the owner commingles that property with marital property or makes it marital property. So let's go through an example. Cam and Alexis are married and reside in California. Among other transactions for the year, the following occurred. A non-taxable dividend was received by Alexis on stock that was given to her by her late father after Alexis's marriage. There was a gain of $20,000 on the sale of unimproved land purchased by Cam before his marriage, and Alexis received natural gas royalties of $10,000 from a lease required with her separate funds after the marriage. So, how are these transactions treated? Let's first start with the stock dividend. Because the dividend was distributed on stock held by Alexis as separate property, it is also her separate property and should be taxed to Alexis only. Now, this is assuming that she hasn't commingled the dividends in the past and that she hasn't included the stock in marital property. The natural gas royalties she received would also be the same, assuming the same set of facts. And additionally, the sale from the unimproved land would be treated as only Cam's property since it was acquired before the marriage and it does not appear that Cam has commingled that property. Let's go to another example. Matt and Shantae are married, but file separate returns. Matt received $60,000 of salary and $300 of taxable interest from a savings account he established in his name. All deposits to the savings account were made from Matt's salary that he earned since the marriage. Shantae collected $2,000 of taxable dividends on stock she inherited from her father. Shantae's income is computed as follows under 3 assumptions to the state of residency of the couple. So, let's talk about the dividends. The dividend is Shantae's, and so based off the fact that it is Shantae's, it would be included in Shantae's income. It would also be included if she were in a state that did not have community property. Because of the rule in Texas, which makes income from separate property community property, she would only be attributed $1,000 of the dividend. The other $1,000 would be included on Matt's tax return. Of the salary, she would be imputed $30,000 of the $60,000 that Matt makes for both California and Texas, as this is community income. But in a common law state, she would not have any income. The interest would be treated the same as the salary for both California and Texas. as the interest was created from community property income. In a common law state, however, she would not be attributed any of the $300 of interest that Matt made from the investment in the savings account. So in total, for California, she would have to include $32,150. In Texas, she would have to include $31,150. And in a common law state, she would have to include $2,000 of income. Now note that the savings account is a community asset because it was created with community funds, Matt's salary. And one other note, because they have community property income and are filing separately, each spouse must include Form 8958 entitled Allocation of Tax Amounts Between Certain Individuals and Community Property States on his or her Form 1040. Now, there is a difference between community property and jointly owned property. Jointly owned property being property owned by tenants in common or joint tenants. It's not limited to married couples, where community property is limited to married couples only. If there are more than two owners, the ownership interests don't need to be equal and will be attributed based off of the percentage ownership of the parties. In community property, though, the spouses don't have to be taxed on one half of the earnings of the other if the individuals live apart for the entire year, they do not file a joint return, or no portion of the earned income is transferred between the individuals. You can also make property that is community property not community property by treating it as separate property. This you can do by writing on the bottom of the property. So one day Matt decides, you know what, I'm going to allow this couch to become community property, and so he writes down community property. The next day he says, nope, this is separate property. I don't want her to have this. And so he writes down Matt. This is Matt's property. You can do that, and that's fine. All right, so that is some of the information that you need to know about sources of income. We'll continue on this topic in our next episode. You've now learned everything you need to know about the fruit of the tree analogy, and you can take that analogy and twist it and play with it to your heart's content, like a lot of tax cases do. You've also learned about how community property plays a role and different types of income, including personal services, property, interest, and dividends. If you have any questions about this information, please leave a comment in the comment box below, or you can email me at centerfortaxstudies@gmail.com. Subscribe and like this if you did, and we'll see you next time.